I want to look at a couple of markets here before the FOMC meeting this afternoon. The first one is energy. I've been beating the drum on energy for several weeks now. I think the turn is in, and as it always happens, no one ever believes me at these intermediate turns, and that's just the way human nature is. The vast majority, 90% of traders, always have to be on the wrong side of the market at these major turns. So I'm going to just look at the charts of the big three. So we've got ConocoPhillips here. You can see in 3 days we've recovered like almost 3 weeks worth of losses. That suggests to me that this is probably a final bottom. Kind of this very similar chart with Chevron. They've broken out above this high. Again, in 3 days, many weeks of losses have been recovered in just 3 or 4 days. Most of the major energy stocks did not follow oil down to a lower low here at this bottom. And I really like this nice long basing pattern here in ExxonMobil. Haven't broken out just yet above this resistance level, but I think we are going to, and that should produce a very nice rally back up towards these highs in Exxon. The next market is the dollar, and we're in the kind of the same position here. I'm calling for an intermediate low. Everybody has gotten seduced to the bear side here because we've had a 5-month, almost 6-month, I guess, intermediate decline. So everybody has become convinced that this downwards move is going to be infinite, that it's never going to turn, just like they were convinced that the energy stocks and oil would never turn back up. And I'm going to say everybody's going to be wrong again on this, just like they are on at every intermediate bottom. I think we probably got the bottom last week, and the dollar is setting up to rally on the FOMC statement. The Fed is going to raise rates this afternoon. The odds are basically 100%, so they are going to raise rates, and I think most market participants are expecting the dollar to drop because it dropped during the last 2 rate hikes. So you see that the last one here was in December, and right after the rate hike, the dollar started this long 6-month, almost 6-month intermediate decline. And so, and the same thing happened with the first rate hike. So traders are assuming that since that's what happened the last 2 times, it's got to happen the same way again this time. But if you'll notice, the last 2 times the dollar was rallying into the rate hike. So it made sense that the market would sell the news and go the other way. We were in a completely different scenario this time. Instead of the dollar rallying into this rate hike, it's been falling for almost 6 months. So I think the rate hike this afternoon will probably do the exact opposite of what everyone is expecting. They're expecting that they think they've got the market figured out. Rate hike means dollar down because that's what happened the last 2 times. I don't think that's what's going to happen this time. I think it's going to do the opposite. I think the rate hike will trigger a rally in the dollar, and we need to have a rally that's lasts long enough and is strong enough to at least break this intermediate downtrend line. That would confirm an intermediate cycle low. I do not think we're going to go above the December, the January high right here, because I think we've probably started a bear market. So So all I'm looking for is a bear market rally, but I think that the rally should probably go far enough to at least break this intermediate trend line. That would confirm that we've got an intermediate cycle low right here. Rally just long enough to get everybody bullish, and then we turn and we go back down and we continue the bear market in earnest. So the most likely scenario that I can come up with at the moment would be that the dollar will rally. We may have an initial head fake lower, just simply because everyone is expecting the dollar to do the same thing this time as it did the last two times. But I think that initial knee-jerk reaction on the announcement will probably be faded, and by the end of the week the dollar will be rising. And the most likely scenario would seem to me to be that the dollar will rally into the July FOMC meeting, and then turn and start back down and maybe start the bear market in earnest. But the dollar is due for a rally that, like I said, goes at least long enough to break this intermediate trend line. And I think that probably gives us the driver for gold to move down, go below the May low. That would be a failed daily cycle. I've said this before. Intermediate cycle lows need to have at least one failed daily cycle, and we don't have that yet. We're still stair-stepping up. We're still making higher lows. We haven't made a lower low yet. We have in silver and miners, but we haven't done it in gold yet. So I suspect that a 4 to 6 week rally in the dollar would be the impetus for gold to move down, break this May low, give us at least one stair step down, and then I think the dollar tops by the July FOMC meeting, and that puts a final intermediate cycle low in gold. Do not think gold is going to move below the December low, although silver and miners very well may. And then I think that's the point at which it becomes obvious that the dollar has begun a bear market, and then I think we get a nice breakout in the latter part of the year in gold, and it becomes clear to everyone that gold has started a new bull market, and I think it breaks out of this basing pattern that it's been in for several months now. And finally here I've got a gold to oil ratio. As you can see here, as oil dropped down into that 3-year cycle low in early 2016, the gold oil ratio spiked to 45 barrels of oil to 1 ounce of gold. You can see that was an extreme anomaly, and ever since then oil has been trying to normalize, and by normal I mean over many decades the normal ratio is somewhere between 15 to 20. It's even been as low as between 10 and 15, but because I think we're about to enter the bubble phase in gold, I think this ratio between oil and gold is kind of ratcheting up a little bit. So you can see during the early part of the last decade, the ratio kind of hovered between 10 and 15 barrels of oil per 1 ounce of gold. This is when oil was moving into its bubble phase, and then once we moved into a world of global QE, that ratio kind of stair-stepped up a level, and normal became something between, let's say, 15 to 20 barrels of oil per 1 ounce of gold. And now I think we're getting ready to start the bubble phase in gold. And so I think this ratio is going to ratchet up again, but clearly 45 barrels of oil is way too cheap for oil compared to an ounce of gold. And you can see ever since that time the ratio has been normalizing. I think at this point the ratio is probably going to hold between 20 to say 25 barrels of oil per ounce of gold until we get that final bubble in gold, and then who knows where the ratio will spike to. But we're due. You can see here as gold has been rallying for the last 5 months, the ratio has been in a counter trend move back up towards the higher side of this ratio. We're at over 27 barrels right now, but I think it's time for oil to rally for a bit and gold to drop down into an intermediate cycle low. So I'm looking for this ratio to make another leg down and maybe get down to maybe 20 barrels of oil per ounce of gold here over the next month or so, as I expect the dollar to produce an intermediate rally, and for oil to rally and gold to correct for at least 4 to maybe 6 weeks.